Yo guys, Leggy here and welcome to another video. So basically the other day someone asked me to do a deep dive into the stocks, why I've chosen them. So I'm going to do it by pie. So we've got about 8 pies, which means that, and I won't go through the ETF ones, so probably about 6 videos we got to go through. So this is the first one, the long-term pie. So firstly, when did I start into this pie? It's the most recent of the ones we've got, with us actually starting paying into it at the end of March. So what is our target for it? As explained in my video here, basically, apart from the S&P 500, I'm trying to get to about a grand in each of them, and I've done it in every single one but this one. So how much do we have in the pie? We've got £400 at the moment, which means we're 600 off the target, and then when we get to that grand, I'll reevaluate and see where we go from there. So in that period, since the end of March, how much money have we made? So, as I said, we're up at about £400 at the moment, and that means we're up £23 3 pence at the time of recording, which means we're 6.11% up, which is actually really good return. So the pie consists of 6 slices. We've got Brookfield, Markle, Blackstone, KKR and Co, 3i Infrastructure, Berkshire Hathaway. So all of these companies are basically asset management companies or holding companies. So now I'm going to fly through some quick terminology. So basically, hedge funds and mutual funds will basically be held with a flat administrative fee, and this is practically how they make their money. So hedge funds have a flat administrative fee, and they get to keep a percentage of profits. Although in years where there's no income, i.e. loss, they still get to keep that flat administrative fee. What you normally find is that the bigger the fund, the bigger the fees. So then you've got mutual funds, which are also heavily regulated. And in this, the fee is normally taken when you either buy or when you sell. There is a thing called an index fund. So you guys might have heard me go on and on about the S&P 500. So basically that is a basket of stocks. The S&P 500 is the 500 largest American stocks. And then you've got other ones which are baskets of other different stocks. But basically the concept is that it's a basket of stocks. And the fee involved with these is basically you get an administration fee. But why is an index fund really important? So index funds, they end up being the benchmark, what investors actually compete against. So when people say, oh, I'm outperforming the market, they mean they're using normally the S&P 500 as a benchmark. So for example, if the S&P 500 has made 10% that year, if I'm outperforming the market, I am doing better than what the S&P 500 returned. So a holding company, which is basically what we're going to be going into, because 2 of the stocks we've got within our portfolio are holding companies, basically being Markle and Berkshire Hathaway. And then basically a holding company holds a bunch of different companies. So let's go into the pros and cons of a holding company. Holding companies also have tax benefits as they can offset losses in one company against profits in another. And obviously, because they're an umbrella company, they can protect themselves more against risk than one singular company because they're more diversified. The 2 main disadvantages is that there's increased risk because obviously it's out of your control because you're not in the day-to-day running, so something can happen which can have an adverse effect on your company. And also they can also be taxed to a double taxation. So holding companies may be subject to double taxation as the income of the companies they own may be taxed at the corporate level and again at the holding company level. So with that out of the way, let's get back to the stocks and go into the first one, which is my favourite, which is Berkshire Hathaway. And I know a lot of people have this as a, you know, lifetime hold. They'll just hold it till forever. And I'm very much like that with this. I really like how they operate. The main question is probably you're asking, why don't I just invest in the S&P 500? And the answer to that is, well, if we look at this news article here, it says it has historically outperformed the S&P 500 over the long term. Now, obviously, past performance is not an indicator of future performance. So, no one's a mind reader. They can't tell what's going to happen in the future. But what's also really interesting is that in the past, if we look at this article here, it actually says that um, Berkshire Hathaway has actually got less volatility than the S&P 500. And if you guys don't know what volatility is, it's basically how much it goes up and down. So it's basically just saying that Berkshire Hathaway fluctuates less. Also, it's important to know, so basically people do stock splits, and basically this means that they split their stock so it becomes more affordable, so more people can afford to buy one stock. So for example, for a retail investor, um, like buying a share at like £20 might be more attractive than buying a share at £20,000 per share. Although Warren Buffett has actually really been against this because he said that he wants to keep quality investors invested in his company. So, how does the company operate? So, basically, their cash producing assets are heavily weighted in stable, low growth assets. So, this is railroads, utilities, insurance. They then take the cash basically generated from that and then they use the cash generated to actually buy really well valued stocks. So why might this be an interesting thing to go over the S&P 500? So basically, as I went into yesterday and I have in the last couple videos, the S&P 500 is heavily weighted um, on the Magnificent Seven. And because of this, it's very, very tech heavy. This means earnings growth justifying the valuation is heavy on these Magnificent Seven stocks at a 20% growth rate when historically this is a unsustainable rate. So the other holding company we have got within our portfolio is Markle. So people say, obviously, if you're going to invest in Markle, why don't you just invest in Berkshire Hathaway? Because basically, Markle's book value growth has lagged Berkshire Hathaway's for the last 5 years. So, what is book value? Book value is basically a company's assets minus their total liabilities. But on the plus side, in the last 3 years, I've got some statistics here. So basically, their operating earnings are up and down, but around 0.9 billion on average in the last 3 years. Their equity portfolio is 7.5 billion. Markle Ventures and other businesses roughly generate approximately 0.36 billion per year in income, and their net cash is around 2.7 billion. So adding that up, their value is around 22.8 billion, which means, and that's versus their current market cap of 17.1 billion. So if we actually look at the stock, which is slightly outdated, those facts. So I know since I brought these stocks at the end of March, you can see that it's actually up by 11.58%, whereas Berkshire Hathaway has only grown by 1.04%. So in the long term, I think I prefer Berkshire Hathaway, but I think it's important that we've got both of them in our portfolio. So the next one we've got is Brookfield Management, and this is not a holding company. This is a global investment firm, as they say on their website. So they've got 925 billion assets under management, and they invest on behalf of institutions and individuals around the world. Now, what I like about them is that they focus on long-term and sustainable growth, which I think is a narrative that will come into play in the future. I think that the further we get towards that 2050, the more there'll be a focus on sustainability. And they've got a really diversified portfolio with real assets, including utility like monopoly infrastructure and premium buildings. So talking about being diversified and why it's a factor why I've actually invested in a lot of these companies. Blackstone is another one which, they're slightly different because their aim is to invest in private sector pension funds, insurance companies, university endowments, institutions, and individuals, but they're also very diversified. So if we look at their assets, which I'll stick here, basically they've got 65.2 billion in real estate, 80 billion in private equity, 45 billion in credit and insurance, and 7.1 billion in hedge fund solutions. KKR is a very similar one of these narratives, going towards infrastructure and real estate. So if we look at Brookfield, Blackstone and KKR within our portfolio, we can have a look at this time. It's not a very long time frame to be judging this on. It's only been about a month, which is, as I said, it's a long-term portfolio. But Brookfield has gone up massive with 11%. Blackstone is up the lowest out of the three, around about 1.78%, so £1. And KKR is just below Brookfield a little bit, up around 9.64%. So, not too bad. So final one we're going to be looking at is 3i, and I've seen a lot of people talk about this, and this is why I actually picked it up. So I need to do a bit more research on the company before improving my position to a sizable amount. But basically they've got a really low PE ratio. So what is a low PE ratio? So PE ratio is basically the proportionate difference between a company's stock price and its earnings per share, so EPS. And then basically, if it's got a low PE ratio, it basically shows that the company is undervalued. PE ratio of 9.12 just shows that it's undervalued at the moment, or could be undervalued at least. Also, as you can see, they've got 34.7 billion assets under management, and they've got value for consumer money and private labels, it's 72.72%, infrastructure and scan lines 9%, healthcare 6%, industrial technology 5%, so they're very diversified as well. So this one, it would be unfair to measure it against the others because I actually added it afterwards. But at the moment, 3i is 1.63%, so it's doing alright. It's doing alright. I got in on the hype a little bit afterwards, but after looking into it, I actually really like what the company's doing. And I'm gonna research it more. But yeah, with that, peace.